Hey guys, welcome to the Market Interest. This is going to be a full-on investment course for beginners. You're going to learn how to find the best investments, research stocks, open a brokerage account, and learn how to avoid some of these huge tax bills. And the cool part is you're getting this 100% free from a financial advisor. I'm securities licensed, a portfolio manager, and help people retire every single day. So everything you hear today is what I'm doing for my personal accounts or what I'm doing for my clients. If you want to stay up to date on my weekly stock picks, don't forget to hit the subscribe button and make sure you go along on that like button. Appreciate it, guys. Now let's get into this. The first thing you need to do is pick a platform that you want to trade on. There are a million self-directed platforms that you can choose from. Companies like Fidelity, Vanguard, Interactive Brokers, Schwab, E-Trade, Robinhood, the list goes on. Each platform has their own advantages and disadvantages, but I would say most people start off choosing one that's just the most convenient for them and potentially based on cost. As a beginner, I'd highly recommend using one of these platforms that's very streamlined, very easy to use. You don't want to get bogged down or held back by all the complexities of some of these online broker dealers. I would say most of the big name companies that you hear on TV all the time are probably a good place to start. Now, if you're very price conscious, I would recommend going on Google or another search engine and just searching schedule of fees. This will tell you everything you need to know about the fees and the structure that that company is charging you to either place a trade or manage any assets. All right, now that you've chosen a platform, we should probably review taxes. This is way more important than what you guys may think. You don't want to ruin your life like this Wall Street Bets kid did, just because you didn't know a couple basic tax rules. And believe me, you'll appreciate some of these tricks that you'll learn right here. And you should note the type of account that you open up is going to determine how you're going to be taxed. So let's get into it. There are three broad categories of accounts represented by the snow tax man. Let's start at the bottom of the snowman. Accounts down here are tax deductible or can help reduce your tax liability for the current year. For example, if you make $50,000 a year and you put $5,000 into the bottom of the snowman, then you're going to tell the IRS that you only made $45,000 this year or only need to pay taxes on $45,000 worth of income. The $5,000 that you put into the bottom of the snowman is tax deductible. Accounts in this area include your 401k, 403b, IRAs, and more. Now, because you didn't pay taxes on any of the money that went into this account, all of the gains and the initial deposit are going to be taxable when you take the money out. The middle of the snowman is pretty much the exact opposite. You're going to pay tax on all the money right now, make your contribution, and the money will grow tax deferred. But when you take money out of this account, all your contributions plus the growth will be tax-free, assuming you meet certain guidelines. And who doesn't love tax-free? These accounts are Roth IRAs or Roth 401ks. Now, these two parts of the snowman are really designed for retirement savings, which means you want to keep the money in these accounts until you're at least 59 and a half to avoid any type of penalties. Now, there are ways to make qualified distributions without penalties, but it's pretty limited in terms of how you can do that. So really you want to designate those funds for retirement longer term. There are going to be a couple other restrictions as well, like how much you can contribute into these accounts. Every year the IRS will come out with certain limits and you can't exceed those amounts. So if you come into a windfall or you're just a really good saver, the IRS is going to limit how much you can contribute to these accounts. Now, the top of the snowman is the most flexible in terms of how much money you can put in and when you can take the money out. There aren't restrictions in terms of how much money you can put in there, when you're putting the money in, or when you're taking the money out, which is pretty nice. It gives you a lot more flexibility. So if you're trying to invest for any other type of goal besides retirement, then this type of account would be a pretty good area. Now, unfortunately, this is the least tax advantageous area to put your money. You're going to be paying taxes on your initial income. You're going to pay tax on any type of interest that you gain here, and you're going to pay tax on any type of capital gains that you receive. So you're pretty much getting taxed everywhere often, but it might not matter that much if you need that liquidity. You need to take money out for an emergency or for any other reason. Now, just keep in mind, you'd only be taxed capital gains on any realized gains at this point in time. Hopefully that doesn't change. So if you buy an investment for $100 and it turns into $200, you won't pay tax on that additional $100 gain until you actually sell the investment. It has to be a realized gain before you're paying taxes. Now, some of these accounts include individual accounts, transfer on death, or joint accounts. Pretty much your everyday brokerage account. All right, let's move to step number 3, which is really just opening up your account, which is pretty simple at this point. If you want this to be for retirement, then you would choose between an IRA or Roth IRA. If you want to have more liquidity, then you'd move towards a brokerage account. If you're the only person on the account, then you can choose individual or a TOD account, which means transfer on death. Now, I like to use TOD accounts because then, God forbid, if anything happens to me, those assets will automatically transfer into my beneficiary's name instead. It doesn't have to go through the entire probate process in order for it to be transferred over. If you want your account to be joint, you can do joint with rights of survivorship or joint tenants in common. With joint rights of survivorship, that means your account is going to be 100% transferred over to the person that you're on the account with. If you're on an account with your spouse or a sibling, fill in the blank, and something happens to you, all those assets will 100% go to that other person. With joint tenants in common, it's slightly different. Let's say I have an account with my brother and I pass away. Instead of him getting all of the assets will go to whoever my beneficiaries were, whether it's on my will or estate plan or listed in the beneficiaries on that account. So the account is split 50-50. These accounts are more common with business owners, so unless that's your scenario, you can skip right over it. Now there are plenty of other account types that you can choose from, but for just basic investing 101 starting off, these are probably the most common ones that you're gonna come across. Now as you're opening your account, it is 100% normal for these companies to be asking you some personal or financial information. They're gonna wanna know things like your net worth, your investment history, social security number, license info, where you work. They need this information to verify it's really you and make sure you're not in business with Marty Bird or Ruth Langmore.
Can you do this for me?
Well, I'm sure you'll tap dance your way straight through whatever this is.
The investment companies are going to report your transactions to the IRS every single year. That way the IRS knows how much you need to pay in taxes. So don't sweat it if they're asking you all this information. It's for a good reason. Now, as you're opening the account, it would be a really good time to link your bank account to the brokerage account as well. That way you can make your transactions pretty seamless. All you have to do is click a few buttons and move money from either your checking, savings account, right over to your investment account or vice versa. I always recommend setting up a consistent contribution into your account, whether it's on a weekly basis, bi-weekly, monthly, whatever it is, just have some type of consistency going right into your investment account. It's going to build a great habit and you're going to be very thankful for it later on. Now that your account is open and funded, it's time to find the best stocks. Now there are thousands and thousands and thousands of stocks listed on all the markets, and it can be super overwhelming to try and find the best one that matches your risk profile, have you understand the stock, and make sure that you're putting your money in a good spot where it's going to grow in the long term. So one thing I try to do to make your life a lot easier is come out with weekly videos talking about different stocks that I'm investing in throughout that week or that I'm building within my clients' portfolios. And we'll do a full deep dive analysis into each one, talk about really important metrics, sometimes even pull in the CEOs and talk about their business models. The better you understand a company's business model and metrics, the easier it's going to be for you to notice different opportunities for growth within those companies. And that's when you'll know when to really put your money to work and invest in that company. So I always review 4 categories at least. There's plenty of different categories or different metrics that you can follow within a company, but these 4 are ones that I look at every single time, without a doubt. There's no questions about it. You need to know these 4. They're risk, profitability, market cap, and valuation. Starting first with their risk. The beta is one way of measuring a stock's volatility compared to the overall market's volatility. The market as a whole has a beta of 1, and stocks with a value greater than 1 means that they're more volatile than the market. If a stock or a fund has a beta under 1, that means it's less volatile than the market. Now, companies with higher betas, you're going to notice they have higher highs and lower lows than the overall market. So if the market's up 5, maybe this stock is up 7. If the company's down 5, then maybe your stock is down 7. Same thing on the flip side, if you have a beta that's under 1 with a lower beta, then you're going to have lower highs and higher lows. Another risk metric is the standard deviation. Standard deviation is the statistical measure of market volatility, measuring how widely prices are dispersed from the average price. You ever see those games where people pour those balls and you have all these pegs everywhere and you see the balls drop down into different areas? The standard deviation measures those distributions. You might have 80% of your investment returns falling within the middle of that distribution, but there could be some lucky times where 10% of the time their returns were higher. They might have the other 10% of the times where their returns were lower. So standard deviation is going to be measuring some of that risk in terms of investment return. There are plenty of other risks that can be measured that I'm not mentioning here, like geopolitical risk, interest rate risk, etc. So really understanding their business model is really important. But for this video, we're just looking at some of the statistics and things that you can look up very quickly. Another area that I look at is their market cap. Now, the market cap of a company will also help explain some of the risks or opportunities or just the overall environment that company's living within. The market cap is the total capitalization a company has, and it's calculated by multiplying the stock price with the total number of shares outstanding. So the market cap really helps us understand like what's the size of this company? Like, are they really small? Are they really large? What are the dynamics within their company or their supply chain? If they're a smaller company, they might not have a lot of control within their supply chain. If they're a huge manufacturer, a huge company, and they've had a great relationship with their vendors, then you know their supply chains are going to be pretty consistent. So there's different dynamics of the overall company by knowing what their market cap is. There are 5 market cap categories. There's micro cap, which is 50 to 300 million, small cap, which is 300 to 2 billion, mid cap, which is 2 billion to 10 billion, large cap, which is 10 billion plus, and then they have a mega cap for $200 billion plus companies, which there really aren't that many of them. Companies like Amazon, Google, Facebook, the big tech companies. Again, there aren't that many of them, but they're mega companies. Now you should know it's common to see smaller cap companies or smaller companies have higher betas, have higher volatility in their stock price. So just something to keep in mind. Larger companies, they're usually more established and their market prices might move a bit, but typically not as much as a smaller cap company. All right, let's move on to the profitability measures. This is really important, guys, because we're investing in a company. And when you give a company your money, you want to make sure you're receiving that money back. And usually that only happens if the company is profitable. Now you've got to note that profitability measures are really relative to other companies similar to them. If I'm looking at a profitability measure of a small cap manufacturing company compared to a large cap tech company, the ratios are going to be way out of line. So you need to be comparing your profitability measures with other companies that are very similar to those that you're analyzing. Within the profitability measures, I usually look at gross margin. This value measures the percent of revenue left after paying all direct production expenses. There's also net income margin, which is the net after-tax income of a business. The net operating income is also important as well because that's really how much income they're getting from their operations, the main reason they're in business. Again, there's plenty of other measures, but those are the really important ones that I would say you should probably know pretty well before investing in a company. Let's jump to valuation measures. Now, this is the most common area that people look at as they're investing in a company. They want to know what the value of a company is. Is it undervalued? Is it overvalued? Or is it fairly valued? Is it a good investment opportunity? Now, when we talk about valuations, this is really expressing what the future growth of a company is. The most commonly used valuation measure is the price to earnings ratio. This is the company's current stock price divided by their previous earnings. Now, if a company has a high price to earnings multiple, that usually means that a lot of the future growth is already baked into it. Higher PE multiples are very common with growth-oriented companies. And as of the last decade, that's typically been a lot of tech-oriented companies. On the flip side, a company with a low price to earnings multiple may be considered undervalued, which means it's being overlooked by the market. People aren't noticing that there's a lot of good value here and aren't buying the stock. You could be entering into a really good stock before everybody else. Now, you'll want to be careful that you aren't falling into any type of value trap, meaning the multiples are low because the company isn't producing in one way or another. It's a very common mistake a lot of investors make by seeing a lower price to earnings multiple, buying that stock, thinking that they're getting in at a great price, but they just didn't understand the full business model. And then they realize after 6 months, a year, hey, this thing is a dog. So I'd say it's really important to know the business model of a company before just looking at the multiple and making your decision on that. But again, it's one of those key statistics that you just have to know, you have to be looking at before diving in and investing in a company. Price to earnings multiples really do matter. All right, let's move to the last step of this, guys. You've opened your account, you know what type of taxes you're going to be paying, you know how to research for the best stocks. Now, we just need to place a trade. There are a bunch of different trades that you can make, but there's a few that are just very common. It can be intimidating the first time around, but I promise you it's pretty easy after that. There are a list of different orders that you can make, but in reality, most people use only 1, 2, or 3 of these trades. The most common is just a regular market order. That means you're putting your request in to buy a security right then on the spot. With a market order, you don't have any say in terms of what the price is, and the prices change within fractions of a second. If you want to have a little bit more control over what you're paying for a security, then most people put in a limit order. That means you are saying exactly what you want to either sell the security for or buy the security for. They don't always come out to be the exact price that you're setting, but they're usually pretty darn close, or maybe fractions of a penny off at times. So it's at least something to note, but if you want to have control over where exactly you're selling or buying a security, a limit order usually works very well. Another good order type is a stop loss order. They're exceptionally useful if you want to protect certain gains that you have or limit the losses within a stock or security. When you put a stop loss order in, you're telling your platform, whether it's Vanguard, Fidelity, I want to sell my stocks at this price if the market is going down. If my stock hits this price, I want to sell everything. Now, these might not work perfectly either. If there is a huge crash in the market, then the execution might happen at a different price than what you're actually setting it at. They typically work really well, especially within very liquid markets where there's a lot of traders. There are really a ton of other orders that you can place. For beginners that are just starting off, I'd say these 3 are really the primary ones, especially just a regular market order. Really good, you're getting the stock that you want when you want it. It creates a lot of liquidity in the markets. Now, those are the main things that you should know about how to invest just starting off. Basic 101. Now, it's really important to know, markets change often and they change fast. So it's really important for you to be a longer term investor, have a longer term game plan, really create a game plan for yourself. And if you don't have one, then feel free to reach out, click the link in the description down below. We can set up a one-on-one consultation and we can review different investment ideas that are appropriate for you. But it's really important for you to have a plan, meet with a financial advisor at some point. But if you're going to be trading on your own, then these are the basic things that you at least need to know to start off. Now, if you want to stay up to date in terms of other stocks and other trading ideas, learn about what's happening in the markets, the economies, then make sure that you're hitting that subscribe button. I come out with a weekly video about what's happening in the markets, interviewing different CEOs or industry leaders, and talking about what's happening in the economies. Don't forget to hit that like button. Really appreciate it, guys, and I'll see you on the next video.